Hello, welcome to the Victor H Investing live stream. What I'm going to do today is I'm going to review the stock market performance for this past week. Today is May 4th, 2024. It was overall a positive week. I wanted to review the performance of the S&P, the NASDAQ, and the Russell 2000. Look at some other factors that I think are weighing on the market or maybe helping the market and just share some comments on what I think is going to happen over the next couple of weeks. What is this all setting up, and how will it affect my investing? So, before I jump into the video or the live stream, just a reminder that I'm sharing my journey as an individual investor. It's just my opinion. It's my journey about my investments. I am not recommending you buy or sell any stock that I talk about, and I am not providing any financial advice. Please weigh your decisions carefully. So, thanks for joining. I appreciate it. Please slack on the or comment in the chat, and if you have any questions or any requests as I go through this. I'm going to start with the S&P. Year to date, the S&P is up 8%. Which is really good. And we really started off the year nicely. This upward slope looks great. And then we hit around March 28th, we hit kind of like the high point. And from the high March 28th to the low, which was April 19th, the S&P went down 5.46%. So it was a nice pullback. It wasn't quite a correction, which is 10% or higher, but it was nice to have that pullback. Now, this is some medicine that the stock market needed. I think the stock market needed some of these prices to be lowered, especially around semiconductor and some of these AI stocks. They were already ridiculous, but they were getting really ridiculous on valuations, and as well as some other stocks. We saw some stocks jump up just because of the AI hype. Now, from the low point that we just experienced, which was on the 19th, to this point, we're up 3.23%, which isn't too bad. Overall, from the high point to where we're at now, we're down 2.41%. So in general, I think the pullback was good. It was constructive in getting rid of some of these high-flying stocks that were just overly priced. And it's good to know that there's been some pullbacks. Now, as we compare the S&P to other indexes like the NASDAQ and the Russell 2000, you can see that they're all, the NASDAQ and the S&P are tracking pretty much together, but the Russell 2000, which is small and mid-sized companies, is not keeping up. The performance on the Russell 2000 year to date is 1.14%. And I was sharing this as we look at companies, as we have had these live streams, people ask about companies, and sometimes they ask about a small company, a company that's not very known. And I keep sharing that these small companies are just not going up in stock price, even though their fundamentals look great, the valuation support that, hey, they're discounted, and they're discounted quite a bit. The investors out there are just not buying small and mid-sized companies. It's more rare than it is, the trend. So I wanted to point that out so that we're aware of, hey, small caps, it may take a while for us to get a really good return. We've got to be careful when we pick small caps, because for the last, let's call it year, the Russell 2000 is not kept up with the S&P and the NASDAQ. Technology's led the way. Communication services has done great. Some sectors that are really rebounding are like financials has rebounded really well, as well as some other sectors. So that's one thing that I take into account as I look at these small and mid-sized companies. I'm just managing how much I invest in those companies, because to this point, they haven't proven to me that they're going to perform just as well as the S&P. If anything, since they haven't performed as well as the S&P, they should begin to outperform the S&P. There's probably some stocks that have been left behind that are going to catch up. And I'm waiting for that event to happen. I'm not seeing the evidence that it's happening as much as I would expect. Looking at where we are from the fear and greed index, which is CNN's index, and I like looking at this. We're still in the fear zone where the market is fearful. I agree with that. I agree that it looks like Dividend Gypsy. Thanks for joining, man. Thanks for the comment. Let's read that comment real quick. Historically, large caps have outperformed small mid caps late in bull markets. Small companies outperform coming out of a recession. Yeah, very good. Now, what's really confused, I guess, the situation a bit is for the last 2 years, it seemed maybe 3, that there was a lot of talk around, hey, we're going to get this recession. We're going to get this recession. And it never came. And I always expected, okay, how deep is the recession going to be? And geez, for the last 2 years, it's like, are we going to have a shallow recession? Are we not going to have a recession? And at this point, I'm not quite sure. I think that the worst case scenario is going to be we have a recession, but it's not going to be too bad. And I would not be surprised if we get to 2025 and look back and say we really didn't have a recession. We just had slow growth. And then the economy can begin to grow. I think the supply chain issues that were a big problem 2 years ago, if you recall, it caused auto prices to really go up. It caused, certain products, appliances and so forth to really be priced high, and it caused a lot of inflation. Well, those supply chain issues are gone, and that's good. And I think that certain industries and certain sectors are beginning to expand and grow, which is good. So you're right, Dividend Gypsy. Coming out of a recession, small and mid-sized companies could probably do better because they're adjusting to, what's happening in their economy within their industry, probably better than these big, massive companies. But I think that the whole conversation around recession has been, if anything, very hard to follow, and it's been unreliable. So we'll see what happens. Good comment. Appreciate it. Back to the fear index. One thing that I've noticed is that the companies that reported, if anything, good earnings, but cautious guidance, and I expect that under those situations, a stock gets beat up and the stock price goes down. But I saw it pretty exaggerated. Like Meta is a good example. It was very exaggerated. CBS, it was very exaggerated. And those stocks really were punished. And I think it's the fear that still exists in the market. I think having fear is good. I think if we have stocks that are just going to outperform forever, I don't think we're going to have a healthy market. We're going to have a market where stocks just get overheated. Like Meta is an example. It announced earnings, then it dropped, and it's dropped in the course of a couple of trading days, 12.8%. That's Meta. So there's a lot of fear around Meta. Hey, they're spending too much on CapEx, maybe, but they did grow and they did show better profitability, and their free cash flows actually grew. So that was interesting. Again, fear is good, so that I felt for months that the stocks were just getting too high, especially around semiconductor, and having some fear in the market and having stock prices go up for merit. Fundamentals are good, valuations are good. It's probably better for us over the long haul. Here's CBS. They announced earnings, and geez, for CBS since April 1st, they've gone down significantly. Year to date, they're down 29%. Over the last month, 25%. I happen to think that CBS is a quality company. They continue to grow their business. If you see their growth year after year, and they did stop growing, I would say that was part of the problem. but it's not like they lost like 20% of their revenue or anything. So the revenue's been there for CVS, really cash flow generator. And now they pay a really nice dividend of 4.76 for CVS. I mean, we're going to need healthcare. We're going to need pharmacies. We're going to need their healthcare payer. We're going to need the insurance they sell. We're going to need the services they provide, because they're also a services provider now. So we'll see how that plays out. That's getting back to this fear that is still in the market. Are we going to get completely out of it? I don't think so. I don't think we have enough news to tell us, hey, we're on this track. We're beginning to grow, and look out. The economy is growing really well. I guess one of the things that came out late in the week on Friday, employment. So the drop in jobs did cause investors to think, okay, the Federal Reserve will be more motivated to drop interest rates. And on Wednesday, they did say, hey, we're not going to raise interest rates anymore. So interest rates are expected to go down. So looks like Dividend Gypsy got another comment. Thank you. What do you think about the Fed's monetary policy? They've indicated that they're prepared to keep rates higher for longer. So I think that the policy is the right policy. Inflation's too high. And if we have high inflation, I know that, over the last couple of years, inflation became really painful. I would have hated to have needed to buy a car 2 years ago. You would have had to overpay for a car. And there was a lot of product types that you were just paying a lot of money for. And that really becomes a problem. The other thing that I'm seeing is, food prices. They're just much more expensive. So if people are having to really struggle to feed themselves, that's a big problem. So first and foremost, I think their policy to tame inflation, they're doing the right thing. How they're going about it, I guess we could critique, what they're doing and how they're doing it. I think the Fed's in a decent spot where they can wait for some inflation reports to come over the next couple of months. They don't have to do anything right now. Keeping interest rates where they're at is reasonable, in my mind, and I can start preparing to just keep this interest rate level. Now, the situation opens up opportunity. Some of the opportunity is investing in fixed income. I've been investing in bonds a lot more because they pay far better. You can get into some corporate bonds that pay a really good yield. And you can get into even some government bonds that pay a decent yield. Even money market accounts pay a really nice yield. If you kept an eye on Berkshire Hathaway's annual meeting, it was incredible how much cash Warren Buffett has right now. He's carrying I think it was 133 or 160 billion dollars of cash. And he's a stock investor. He's not a fixed income guy. But I imagine it's a lot easier to keep that kind of cash around when you're earning, I imagine Warren Buffett earns around 5%. He probably gets into some situations that are more favorable than, let's say, I can get into. I'm earning on my cash a little over 4% in money market accounts, and that's probably going to stay there, maybe rise. So the policy that the Fed is following makes sense to me from an economy perspective. What needs to change perspective, inflation needs to go down. And I'm going to kind of hang my hat on that, expecting that interest rates for at least the next 12 months are going to be about the same where we're at. They may start to drop, but I'll just plan on that. I've increased the discount rates that I use on my valuations as I value companies based on their free cash flows and their earnings per share. I've increased the discount rate, which has the opposite effect on the valuation. It makes those companies less valuable. So that's my answer to your question on what I think about the Fed's monetary policy. Okay, so we went over kind of like where the market's at, some of the big news that came out. Now let's talk about some earnings that did come out, and I'll go over Apple. So Apple, after a pretty, what was it, about a year and a quarter, year and a half of nothing new, nothing exciting coming out of Apple. And they still have nothing new, nothing exciting coming out. Obviously, they have a very big business in the whole smartphone market. And they have an ecosystem around, the fact that they developed their own operating system. Apple iOS is the operating system on our iPhones. I'm an iPhone user, and I pay for 4 iPhones in my household because my wonderful wife loves Apple, and that's where we're going to go. Now, they have a great business, but they don't have anything new and exciting, and we haven't heard their AI strategy. So all those things taken into account, and kind of like the latest on Apple would be that Berkshire Hathaway sold 13% of their position in Apple. Not a big surprise. So having said that, the stock price over the last year has really come down. If we look at the 1 year, it's had some high points, and it's up 11%, but that's kind of deceiving because at one point it was supposed to have been appreciating at 40%. So you can see that we've kind of been somewhat sideways for about a year. And I felt that it was a good time to buy Apple. It's a great company. I think it's an awesome company, but I thought it was a little overpriced when it was around 3 trillion. Now it's kind of been priced up. So I was able to get in. I think I invested about $7,000, and I made a little bit of money on Apple. So it was good to get into that investment. Now, the earnings reports that we're seeing from Apple, Alphabet, Microsoft, these big players, the big dogs, they've been favorable. They're growing. And some lesser known names like 3M had a really good earnings. You can see their stock just took off on their earnings. And 3M story is it's a rebound story. They had legal problems, and it looks like they're getting those put to rest, and the company should be doing better. And they pay this really nice dividend of 6%. So I started getting into 3M, and it really offered up really nice prices. I'm doing really well with 3M. I've owned it for less than 3-4 months. I'm up on the stock. It pays a dividend. They spun off Solventum, so they gave me stocks and shares in that company. So overall, 3M's been a real winner, and I am a fan of 3M. It's one of the great American companies. It's great to see it do well because it's a very well-known brand that I like. So earnings reports have been positive. Another comment from Dividend Gypsy, Vanguard Money Market Fund currently yields over 5%. Very good to know. I mean, a yield over 5% with low risk. See, a lot of investors, and I've seen these types of comments on my videos, investors are recognizing that, hey, I can do 5%. And, some stocks, I mean, just look at 3M as an example. You have volatility in stocks. Even a really well-known company like 3M can have this volatility. Or think of the CVS volatility, or think of the Apple volatility that I showed a minute ago. So a yield of 5%, that's really compelling to a lot of investors. Investing really needs to be personalized to that person or that family's, what they're trying to achieve. And as a person speaking from real life experience gets older and you begin to need the money from that portfolio, these yields really help that investor. And I think for that investor, we haven't seen these conditions in a while. If we look at interest rates, and I think this is a good chart for interest rates. we look at the conditions on interest rates, and the 10-year is what is looked at most often. And I'm going to go all just to get a really long, timeline. The last time we were here was 2007. That's the last time we were at these interest rate levels. After that, interest rates were really low. And especially during COVID, you just couldn't go into a money market account. They were paying you like, I don't know, 0.5%, 1%. It was just brutal. And as interest rates rose, if you were in bonds, you just got murdered. If you remember the Silicon Valley Bank, it went bankrupt. They had to run on that bank. The problem they had was they bought long-term bonds during this really low period of interest rates. As interest rates rise, the price of bonds falls because the implied risk yield on that bond is lower. So they have to drop the price of the bond in order to compensate the investor at the higher interest rates. So Silicon Valley Bank was sitting on long bonds, which ended up losing a lot of value. They had to state those losses, and that's what caused all the fear around Silicon Valley Bank. There was a run on the bank, and they had to go under. I think another institution bought them for their assets, and that's behind us. Here for a long time, since 2007. If we look at the 5-year path of interest rates, it's really been a rise. Here, this is where I was speaking. The interest rates are so low here, you just couldn't touch bonds. When I would say that in the late 80s, early 90s, I mean, I was investing as much as I am now, but in the early 90s, when I began to invest, bonds were performing. You had Bill Gross was the bond king. His total return fund was yielding 10, 12% on bonds. I mean, that was really impressive. So you could diversify into bonds back in the day and still go after, appreciation with stocks, but put money in bonds. And then you had a better balance of diversification. But once we got into really low rates, I mean, during these years here, I had 95% of my money in stocks, a little bit of crypto, and I'm not including real estate. I'm a real estate investor, but I'm not going to include that. So I'm like 95% in either stocks or cash in my brokerage, ready to invest in stocks. But I stayed out of bonds. I started to accumulate bonds once I realized, hey, you know what? I am going to start building a bond portfolio because these interest rates are really going to be desirable. I'm filming a video on my income portfolio. And one of the goals that I have is to have my overall portfolio based on dividends and interest on bonds generate $120,000 a year in dividends and interest. And I want that because in my retirement, that'll pay for my living expenses and I never have to touch the principal of my portfolio. That video will be released. It'll probably be released in 2-3 days. And you'll see that in that portfolio, I have a fairly big chunk of bonds. I've been investing in bonds. Now, I'm pumping the brakes a little bit on my bond purchases because I did buy quite a bit of bonds, but it's a really good opportunity to, if anything, just get more educated on bonds because they're making more money. And if you're making money with very little risk, it's really attractive, especially as you approach life events. Let's say you're going to buy a house. You want to buy a house in 5 years. Well, it's a little risky to put, your savings toward that house, that down payment in the stock market. Either in 5 years, you're going to be really happy. Oh man, I had a return of 15 to 20%. I took that money and grew it and I can buy a bigger house. But what could also happen is like 2022. Oh no, I lost 35% in 1 year and it depleted a lot of the money that I had for that down payment. And now I have to put off buying that house another 2, 3 years so I can recover. Well, with these yields, if you're looking at a life event like, hey, I'm going to buy a house in 5 years, or a son or daughter is going to go off to college in 7, 8, 9 years, you know, you could put money in a safer investment that isn't going to be a piece. I haven't talked about bonds. I've talked about bonds on my channel for the last 2 years. You can find videos on it, but they don't get many views. And to me, that just means that people were not interested. But there's far more interest based on comments like you're seeing on the live stream right now from Dividend Gypsy, and the comments I'm seeing on videos where people are posting that they're making good returns on money market accounts as well as bonds themselves. Good stuff. Thank you. All right. So getting back to my plan for this week. So what I wanted to do is kind of go over the stocks that I'm planning to buy. And FYI, if you guys have a stock you guys want me to talk about, put it in the comments and I'll jump on that stock. We can, review it, and I'll provide my comments on it if you'd like. Okay, so I started my list here, and I wanted to provide comments on the stocks that I plan to buy this week. Some stocks I have a big enough position. Let's say Ford. I really like Ford, and I think it's going to go up in value. It pays a really nice dividend, but I have enough of it. I've invested $54,667, and that's all the Ford that I want to buy, and that's the only automobile company I have. So I'm good with Ford. The stocks that I am buying are MPW, which is a high risk company. I have invested a whole lot. It's been a small investment, but they're going to do their earnings on May 9th. And if their earnings are good, this stock's really going to rally. 37% of the shares are being shorted. So they could be a short squeeze on MPW. So I'm buying shares into the company. It's been on a really nice rise over the last 2 weeks. I think if I'm correct, it's up more than 20% in the last couple of weeks, because I think the short sellers are getting nervous, and some of the investors that want to see a squeeze are also getting excited and buying into MPW. So we'll see what happens. But I've got a small position there. I continue to buy in Alibaba. There's just too much value there to ignore. And it is a way for me to diversify. Most of my stocks are in the US. It's nice to diversify into China, where, that economy continues to grow. They continue to get, their the earnings for people there continue to go up. So they continue to buy in Alibaba. Alibaba also it's pretty much, it resembles Amazon. They have a cloud business, they have a commerce business, they have Alipay. I mean, there's a lot of things there. It's just too much value to ignore. I keep buying into Alibaba. Alphabet. I've been buying into Alphabet for months, and when all the bad news was hitting Alphabet, I continue to know that, hey, this is one of the most valuable companies on earth. Now they're worth $2 trillion, but I continue to buy into them. I think I've invested. This is my second biggest individual stock investment that I have, and it's really beginning to work. I think the Alphabet stocks really been on the rise, and the news is really turning the other way. Their AI business is really credible, and I think they're going to do really well going forward. Meta is been doing great. I continue to buy into them because I think the sell-off after their earnings was really overdone. It was just ridiculous. I think their earnings were good. I really like their earnings. They said, hey, we're going to spend more money on the AI business. That's good news to me, because I think they're one of the few companies that really can pull off an AI business. They have the users, they have billions of users, they have the data, they have the money to buy into, that type of business. So I continue to buy into Meta. Netflix, I continue to buy into Netflix. I used to own about $50,000, $60,000 in Netflix. I sold a majority of it and took a big gain. This one here, United Therapeutics, has really been rallying lately. And it's an interesting biotech life sciences company. And I've got a small investment in them. An investment that I think I might be too early on, it's going to take a while, is Chegg. But if you look at their AI business, I'm a believer. I really like their AI business, and I'm going to keep buying shares. That's going to be a long-term play, and we'll see if it happens. Adobe got really discounted, to my surprise. I made money on Adobe historically, and then I sold my whole position, and the stock price dropped. And okay, great, I'll buy it. Comcast is one of the businesses that I started to buy recently. I did a video on it. I think I released today, and you can hear my comments on it. But again, this stock price really dropped. I made really good returns on Comcast. Made a great return. They pay a nice dividend, and the stock price has really come down. I'm a buyer. Starbucks, the stock has really come down significantly. And I can't ignore the value. I think Starbucks is going to have a bad year, but that's great for a value investor. I'll buy now, hold it for years, and it'll make good money. They pay a nice dividend as well. Nike, I did a video on it 2-3 weeks ago, started buying into it. The only problem that I've had with Nike is that when I started to buy into it, it started to rally. I think I got somewhere near the bottom. And that's good and bad. You know, my initial, I think I always like starting with $1,000 investment. That just took off. The problem is it was hard to buy more shares. So I've been trying to buy on pullbacks, and I wouldn't mind owning, you know, $30,000, $40,000 of Nike, $30,000, $40,000 of Starbucks, $20,000 to $30,000 of Comcast. So those are the stocks that I'm looking to buy this week. Those are the ones that are on my list. The ones that buy big, this label. The reason for that is you can see that the value of my investment in those stocks isn't very high, but I really like those companies. So I'm willing to buy in bigger investment, buys. Instead of buying a couple $100, maybe I'll go $1,000, $2,000 per purchase, so that I could really bring that investment up in those companies. All right. So this coming week, I think we have all the big, I'm going to call star companies that announced. I think there's maybe a couple left, but I think that the big news is out there. The earnings have been good. Earnings have been good with companies that are small. Some of these comeback stories like 3M, they're coming back. The other comeback story that I'm tracking is Intel. I bought into Intel, and this company can't get out of their own way, it seems. And why am I not finding this symbol? Here we go. So it seems like this company can't get out of their own way, and a lot of bad news kind of follows them. Well, I think strategically, something I heard this week that made a lot of sense to me, that make me want to buy more Intel. I'm kind of pumping the brakes at the moment, but I'm probably going to start buying more shares. Is that Intel, as you may have heard, is starting a new foundry in the state of Ohio. Big money being invested. And what they're intending on doing is having a foundry operation that rivals TSM. Okay, that's interesting. And what I'm going to try to do here is, I think I could do it. Okay, so we have Intel on this side, and I'll try to open up the same for TSM. So market cap of TSM, $654 billion. Market cap of Intel, $131 million. Revenue, TSM, $70 and our friends at Intel 55. If Intel gets their foundries off the ground and they're able to provide onshore foundry services, because keep in mind, these semiconductor companies, they don't have like 1,000 people working on the production line. They have like a few people, and it's all robotics. ASML, a company out of Holland, they create these big machines that create these semiconductors. So whether you're producing it in Taiwan, which is where TSM is, or Phoenix, where Intel has a lot of operations, or Ohio, the amount of labor you put into production is not very high. So there's no like competitive advantage to making it in China or making it in the US from a labor perspective. But there's a huge advantage if you do it onshore, and those chips are going to be distributed, here locally to automobile companies, appliance companies, you name it. There's semiconductors and everything. So having, I think onshore capacity is going to be an advantage. I think it's a big opportunity to look at Intel long term, because the market cap, Intel's market cap used to be near 300 billion, and that's when 300 billion really meant something. And they have not kept up, obviously, with the other semiconductor companies. But as I look at their peer, which is TSM, both of these do, full fabrication of semiconductors. I like this long-term opportunity in Intel. So I'm going to keep looking at Intel and keep building a position. One of the positions that did work for me, I'm an investor in Qualcomm. I bought about $15,000 of Qualcomm, and it's really done it's done well over the last couple of weeks, especially after their earnings. So we'll see how things play out in semiconductors. All right, good stuff. So I see there's 9 people on the stream. Please ask questions. I'll go wherever you guys want to go. If not, I'll keep talking about companies that I think are interesting to talk about. But please put in the comments any question you have. If it's a topic, if you want to talk about, investing, put it out there, and I'll provide comments. All right, so let's go to Qualcomm real quick. So Qualcomm specializes more in semiconductors for mobile devices, and they're known for putting their semiconductors in the iPhone as well as the Samsung device, which is operated by Android. But you look at their stock chart, it looks great. And you look at this drop here, that was a really nice opportunity. And that's where I took advantage of buying into. I bought into Qualcomm earlier in the year, and then a few more shares around this zone. And then the stock price kept going up. So right now I'm going to just, wait a while and see what I want to do with that stock. If I want to buy more shares or just hold. But it's easy to hold this stock because they do pay a dividend, and it has good momentum. They came out with their earnings. The market really liked their earnings. They showed that the Samsung smartphone market is actually doing better than expected. So I think that's what drove some of the enthusiasm for Qualcomm. All right, Bad Omen. Thanks for showing up again, man. Nice to see you. Bad Omen says, what would you recommend diversifying your wealth? Like what percent would you have in a high yield savings account, stocks, etc.? All right. So good, very good question. So it's about, and we're going to talk this more like, a life plan, like for me, and I'm going to talk about how I would go about it. You start off, with what budget do you need, right? What kind of cash flow do you need? And it might be, well, I don't need anything. Okay. And the question is, how much do you need today? How much are you going to need in 5 years? How much are you going to need in 10 years? If, let's say I was 25 and I'm like, I don't need any of this money. I'm, good working and I have some fun and I do some traveling, but for the most part, I'm really excited about my career. I'm working on a master's and I keep making myself more valuable, increasing my salary and so forth. For that 25-year-old, growth stocks all day long. Bonds, I don't know that bonds need to be a big part of your portfolio, maybe just to learn a little bit, but it should really be about, if you look at the average return, let's look at the NASDAQ. And this graph doesn't help us a whole lot, but the NASDAQ over the last 5 years, 100% return, or 97.9% return on the NASDAQ. These are more risky stocks. So from the top of the last peak to the bottom, they went down 35%. But if you're 25, you're buying into these drops. You just keep putting money into high risk, growth. And over a 30-year timeline, if you go from year 2000, let's see, right now we're at 24. So let's go from 94 to this point, you're up 20x your money. So yeah, you're going to have some adversity along the way, but that's the kind of return you should think about at 25. 35, you're still, making yourself more valuable through your career, through your work. Maybe you're working your primary job and a side hustle, and you're putting money away. You're buying real estate because you think, okay, great, I can accumulate some wealth there. At 35, I wouldn't think you'd put a ton of money in bonds or high yield accounts. It should still be, in my opinion, for myself at 35, I'd be putting it into equities, stocks that I really like, that I think are going to be really worth something in 10, 20 years. So let's move up to 45. Okay, 45, you're like, okay, I got to send a kid off to college. Might be a scenario. That's a real life scenario for me. I've put through two sons through college. No issue. I let my sons pick any college they wanted to go to, which is one of the payoffs of investing. Hey, go to any college you want. Private, public, doesn't matter. I got the money. We've been saving it for a long time. There's no stress around that. And they get to pick whatever college they want. Or, hey, I want to buy a property. I'm 45 and I want to buy the home that I want to live in for the rest of my life. Okay. So when scenarios like that happen, maybe that's where we start thinking about, okay, let's put some money, maybe 30%, 40% into something that's not a stock. Something that, hey, if the stock market goes, really bad, I got 30, 40% of my money over here that's in bonds, money market accounts, that type of hedge. Because you can weather the downturn in stocks. And we had one just a year and a half ago, the very bottom of the last very good correction, October 14th, 2022. That was a year and a half ago. So when you get into this situation, if you're diversified and you have bonds in your portfolio, let's say you did have 40%, maybe even 50%. If I was in that situation, I would take some of that bond money and put it in the market, knowing what I know over time is like, hey, put money in here. I was putting as much money as I could into the market during this time. I never sold one stock. I never pulled $1 from my investments when we had this crash back in COVID. Every crash we've had over the last, I've been investing for, call it 35 years. Every crash, including if you remember when we had 9/11, I didn't sell one stock. I didn't pull $1 from my investments. I actually increased my investments. Like, okay, right now I got to buy more because everything's discounted. And that really paid off. Right. So it's age specific. And it's also, so bad omen, trying to answer the question kind of holistically, age specific, because let's say you're 65 and you're like, hey, you know what? Don't want to work anymore. Okay. Then I would want to know that I've got the next 5 years of living expenses completely covered. And that would be in money market accounts, bonds, and it would be bonds that were pretty safe. That would be my approach. And it depends on your net worth, right? If you have all your living expenses covered with 20% of your portfolio, then that could go into something that's super safe. And then from there, if you're like, I just don't want to worry about it, maybe you increase it to, I don't know, 50% if you're 65, 60%, 80%, however much makes you get a better night's sleep, go for it. I happen to feel like I'm going to be the guy that, like Warren Buffett, he still mixes it up with equities. He's like mid 90s, man. He doesn't need a retirement account, but he still sees great value in companies like Apple. And he was definitely right. He was so right about that. I know he sold 13% of his stake, but he made that investment in Apple, massive one, in his late 80s, early 90s. So those are some comments around how much you put into high yield savings account versus stocks. You first got to take care of yourself from your living expenses. You got to project that out. That should always be in a high yield savings account or bonds. But just talking about the money that you don't need for the next 10 years, 20 years, that's where I really favor stocks because they just perform so much better, especially over the last 20 years, especially over the last 10 years. Stocks have outperformed bonds. You can't even compare it. All right, got another question from Tommy. Nice to see you again. Thanks for joining. How many stock and what? Okay, how many stock and what stock you holding from beginning of your investing? Okay, so I think at the very beginning when I started investing, and consider this, back then I was 25 years old. I didn't have the experience that I have today. I bought stocks that I understood. So some of the early stocks that I owned were Disney, Chevron, Sun Microsystems, which is, now they were acquired by somebody, but they do high performance technology. I invested in companies like General Motors and companies that I could get my head around. And I invested in mutual funds, which are now called ETFs. And I would say that 80% of my investments at 25 were in mutual funds, ETFs, and about 20% was in individual stocks. My individual stocks, some of them did really well, and some of them crashed and burned. I was an investor in Webvan, which was a grocery delivery company. They're ahead of their time, and they went bankrupt. So that's one of my big losses. I think I lost like $2,000. But I've had some great winners too. I was an investor in the Magellan Fund, which was Peter Lynch's fund, and that thing would do like 30% return a year. It was great. And that was one of my big investments. So if you're young and this is new to you, or whatever age you are and this is new to you, I would say that you always start with something that you can understand. Start investing in companies that you can understand. Hey, maybe you've been working in healthcare for 10 years. Well, look at some healthcare stocks. You probably know how hospitals and people consume healthcare services, pharmaceuticals, those types of things. You probably have an advantage from an information and perspective that not all investors are going to have. So you probably have an advantage there. And then investigate some companies, put an investment. Now, the biggest investment you'll make is your time, and investigate that sector in those industries that you, just by what you've been doing over the last 10, 20 years, have an information advantage. And then you go into those stocks. If you're new, put a fair amount into ETFs, mutual funds that you feel are good investments. Try to keep your fees down. Like Vanguard is great. Vanguard, I think Dividend Gypsy recommended Vanguard Money Market Fund. Vanguard has been awesome at having very low fees. You can buy the S&P index through Vanguard and have very low fees. So you can get into ETFs that you feel, okay, it's a good way of investing into the stock market without having to know everything at the very beginning. And then maybe for fixed income, you can go into maybe some high yield bonds if you are up for it, if you're young, or maybe some low risk bonds as well. They're paying quite well. I'm talking about an ETF still. So those are kind of like some general things that I would think about if I was getting started. The thing that what I would put out there is one of the biggest returns that I've gotten is learning and being able to say, okay, I knew Meta was a good investment and I've done well with Meta, but that didn't happen because I started investing, 2 days before I started investing in Meta. It's because for the last 20 years I was investing, and yeah, I had some stocks that crashed and burned and I did really poorly with, but I learned from that. And then it prepared me to make bigger bets and make more money. So, all right, Teutonomy. I'm in your age, Victor, but didn't invest much in the stock market. Okay. So here's what's revolutionized investing is the internet and access to information, YouTube, free trades. I mean, it just keeps getting better and better and better. When I was investing 30 years ago, you had to pay roughly, it was either, I think it was $25 to buy and $25 to sell. It was really expensive. And I mean, I wasn't investing like, oh, I'm going to buy $100,000 of shares. And that $25 is, a tiny little, decimal point. No, I'm like, hey, man, I'm average guy. I'm not going to, I have $5,000 to invest and I don't want to buy it all in one stock. Maybe I want to spread it across 5 stocks. That's $125 of fees right there just to buy in. And if I want to average in my purchases, it's $25 every single. That's gone thanks to Robinhood. So where I'm going is that if you study on YouTube and determine the type of investor you want to be, maybe, and you can probably find 5 investors online and read some books on investors that you kind of identify with, and then learn as much as you can quickly. You can become a very good investor within a couple of years. Don't take risks that you can't handle at this time. Drive the speed that you are comfortable driving. But you can catch up very fast because you have YouTube. There's 20 websites I can lead you to where you can get really good information. But the best, like if you're new, you want to have good structure. First, what is it you want to accomplish? What's your situation? How much can you invest? And what is it you want to accomplish? Be reasonable with your goals. Hey, I want to make $50,000 a year. I want to make $100,000 a year in appreciation, dividends, and so forth. I want to get to a point where this is the kind of income I'm producing out of my portfolio. Then go learn. You got to learn some basics of, how do you value a company? I value companies based on free cash flows, and I value real estate based on free cash flows. Very similar. But once you learn from others, like Scott's due diligence is excellent. He goes through every step of valuing a company. There's other investors and they do it differently. Try to find investors that you really understand and you understand their examples. Doesn't mean you're going to follow them because you may be like, no, I'm never going to invest in I don't invest in cigarette companies. And I'm not here to, say negative things about smoking or anything. It's just a choice. Hey, I don't invest in cigarette companies. That's it. I don't invest in certain industries. So if an investor says, hey, I got this great cigarette stock, okay, that's for another investor. No problem. I'm not making any judgment. I'm just saying for me, I don't buy those types of companies. Some people would say the same thing about an oil company. Like, oh man, oil companies are horrible. I invest in oil companies. I'm fine with oil companies. So you first, I think access to learning has never been better. And YouTube is phenomenal. I don't need to convince you guys you're on YouTube now. From whether you need to fix a kitchen faucet or you need to learn how to do a net present value calculation of a stream of cash flows, you can learn that on YouTube. You just need to apply yourself, have good structure, read a couple good books. Peter Lynch, I love Peter Lynch. Peter Lynch was a non-finance guy who worked at Fidelity, and he did not work as a fund manager. He worked in a different role, different capacity. He saw what fund managers did and he said, hey, I'd like to try that. He learned it. And he learned it in the 70s. Information was not as easy to get to back then. He ended up becoming the best investor for mutual funds for like 5 years. His Magellan fund beat everybody for 5 straight years. Peter Lynch, non-finance guy. He used a lot of I love the way he expressed it. You use your personal experiences and what you find interesting as your advantage. That's your advantage. You don't go read a book and say, okay, you should invest in a semiconductor company, in a software company. No, you use your personal experiences to find those sectors and industries that you're going to have an information, knowledge, and passion advantage in the stock market. So read Peter Lynch's book, One Up on Wall Street. Great book. And I think you can probably YouTube it and you can hear it. You know, somebody will be reading it out. And that's a really good book. Warren Buffett's, I guess, he learned his philosophy from a guy, Graham. I think it was Ben Graham. And my complaint about that concept is it's 100 years old. And yes, there's some good principles there. Very good principles. I just don't think that it applies perfectly. I really like marrying old school investing principles with new school, like Peter Lynch. My favorites currently that I like to listen to, Tom Lee. He's a very growth bull. You're like, oh man, stock market's always going to be great kind of guy. And some other guys that manage their investments. I like listening to people that are investing versus you hear some people on YouTube where they just theorize and they're always analyzing and they theorize and they're always analyzing. If I know that that person's putting their hard-earned money that they've been working to save up for 20 years, it has a different meaning to me. You know, those guys are playing, you know, for a real return as opposed to just voicing an opinion. Like Jim Cramer, I love Jim Cramer. I think he's really entertaining, but he's serving many masters. When he has comments, I think he has a really tight relationship with CEOs. And once he has a tight relationship with a CEO, he just says good things about that company. Well, that's bad because I can't trust what he says now. You know, call it like you see it. And he used to be that guy. He used to be kind of like, he would say things that people didn't want to hear. Like he called the great subprime market meltdown. He called it early. He got in trouble with the network because the government cracked down on him and told him, you're creating hysteria. And like 24 hours later, everything Jim Cramer said was becoming true. And then he was vindicated. Well, that's the kind of stuff I want to hear. I want to hear from guys and gals that are like, hey, like Warren Buffett came out. He said he lost a lot of money on Paramount, symbol para. That's Warren Buffett. He has so much credibility. He doesn't have to re-legitimize himself. Warren Buffett's freaking awesome. And he has the confidence to just put it out there and said, hey, it was his call, 100% his call. He didn't throw anybody in his team under the bus. He put a lot of money into Paramount. He lost a lot of money and they completely exited that position. That's the kind of stuff I want to listen to, because now when you look at Warren Buffett's brilliant buy on Apple, you're like, he's great. He's awesome. How can I learn to be, 5% as good as Warren Buffett? That's all I need to be. I don't need to be like him because that's like, might be impossible. I just want to be, so he read Ben Graham. He's a value investor. He values based on free cash flows. And you just study that. And then your biggest investment will be your time, and, invest at your speed. Don't try to do it too fast. The other thing too is learn from everything. Learn from your mistakes and learn from your successes. Don't be too hard on yourself when you do buy an investment and it goes wrong. Be patient. Warren Buffett says that before you start investing, you have to establish the internal fortitude. You have to be emotionally ready to invest, meaning you buy Meta at 300, it drops down to 90, and you still believe that Meta is a great company. 12 months later, you've been vindicated and you doubled your money. That's a very recent example, but you have to, if anything, intellectually tell yourself that, hey, I need to know that if I believe in a company like Meta and it starts this downward slope and it's down 76%, that I made a good decision. I believe that Meta, with the billions of users around the world, is a very valuable business, generating the free cash flow they generate, growing the top line revenue the way they grow it. I believe I made a good decision, and I'm going to keep buying in this zone. So when it takes off here, obviously this is easy emotionally to go up 400% on your investment, but emotionally this is very difficult. So I would say that the psychology is, don't bite off everything at one time where you just you become overly stressed, but there will be some stress involved if you get into a position. I mean, Meta is a high quality company, and this is what happened to Meta. You look at Netflix. Netflix had a similar journey where it went way up here and went way down here. That was a 74% drop in Netflix. The number one streaming company on earth was discounted that much. And then whoever said the market's crazy and I'm buying could have taken a ride on Netflix and taken the elevator up and achieved a 230% return in roughly a year and 3/4. So I'm kind of throwing a lot at you, but walk away knowing that, hey, you got to decide, the investor you want to be. Try to find investors online that you can understand. You don't have to agree with them. I get a lot from guys that I do not agree with. I think they're brilliant. They invest a different way. Every time they talk, I learn something. So I listen. They may be like, hey, they love companies that I hate, but when I listen to them and I look at their analysis, I learn something. So, all right. So I was on that for a while. Sorry about that. All my investments was in heavy rental properties. Good for you. Well, real estate did awesome for the last 20 years. I think the last 2 years have been pretty shaky. I rent properties myself, and it's been incredible to see real estate continue to rise because you have high interest rates. I don't know who could afford properties these days. But if you invested in real estate and did well, congratulations. Teutonomy, I started 2 years ago and I'm learning what to do, getting very close to 6-digit on my portfolio. Good for you, man. I think if you become better each month, become better each year, you're going to do great. Okay. So $1,000 to $1,500 in income, 3 more years is my goal. Very good. You'd like to buy a 68 Dodge Charger. And I want one before they pay for it. That's great. Well, those are good goals. I think your income is very doable. $1,000 to $1,500, especially, companies are paying really good dividends, especially if you catch them when they've been, sold off, really discounted. You can really catch companies paying a nice dividend. And I think you could definitely get there. And the Dodge Charger 68, I don't know what those things cost, but they really look cool. So good luck with both. Um, Thank you for watching. I appreciate you watching the live stream. I'm not stressing when I'm down on stock price. Always mad when why didn't I buy? Yeah, isn't that funny? So we're really frustrated when we miss a move, especially if you're looking at a company and you don't pull the trigger. That could be frustrating. So uh, in general, you know, drive the speed you can, right? It sounds like if you're going to be in a Dodge Charger, you might be a thrill seeker, but if you buy into stocks, take a chance once in a while, um, you know, because sometimes when you take a chance and it works, it unlocks something that gives you greater potential. But again, drive at your own speed. You own 47 apartments. That is awesome. Congratulations. I have, I have to imagine that you're really well off. Congratulations. That's awesome. And then 70 to 100 grand for those chargers, huh? Well, I don't know much about muscle cars, collector cars. I do know that those cars look super cool, and I hope you get there and get to drive your '68 Dodge Charger. All right, awesome. So we've been going for a little over an hour. It's been a really fun live stream. Any last questions before we wrap it up? Thank you all for the questions. Thank you all for the participation. I really appreciate everybody watching the videos, and I really enjoy it because I put a lot of time and energy into investing in stocks. And investing in a way is a very lonely activity because you don't get to talk to many people about it. But through YouTube, I get to share my experience and just put it out there. I've learned a ton on YouTube. I can't tell you how great YouTube has been. And again, like from working on your car and changing the alternator to learning how to do calculus, you can learn it on YouTube, which has been great. So Gabriel Valenzuela, thanks for joining. Really appreciate you joining. Appreciate it. And then Teutonomy, thanks for all the great chats. Bad Omen, thanks for tuning in. Really appreciate you. Thanks for joining. Yeah, it looks like Gabriel's 25 years old, and a more aggressive investing is a good idea, but the great idea every single time is learn, invest your time, really, you know, um, show up with an eagerness to learn something difficult, learn how to value companies, learn how to read through their financial statements, learn how accounting works, learn how to read through an earnings report, learn the psychology of the market, learn from like other example investors. That's what I really, at 25, if you can commit to learning, you will have more money than you and your family will need if you commit to learning, because you're going to have some losses, but over time, you're going to learn to make money and you're going to learn where to invest, and you just continue to grow. It'll become a lifelong habit, and you'll become really informed and really control the way that you're going to grow your wealth. So good luck out there. All right, great video ideas. Yep. And there's a lot of good investors. Try to find people you identify with, right? If they make sense to you, that's probably making sense. I know that there's a lot of videos out there, and this is more of an opinion than anything, but they're a little bit of kind of like showboat videos, like, oh, look at me, I'm driving you know, uh, a Lamborghini, so I must be a good investor. Maybe, but I'd rather have guys like, hey, I own 47 rental units or apartments. That's real wealth. Warren Buffett, he doesn't drive a Lamborghini. Warren Buffett, famous story, the wife of Bill Gates, Melinda Gates, went to McDonald's with him, and our man Warren Buffett pulled out coupons. Dude's like so wealthy, and he's still saving a few bucks at McDonald's. I'm more of that guy. I'm happy to send my son to a really expensive private university, No problem. Got no problem with that. And I'll put my wife in a really nice car because I want her to be safe. Got no problem with that. But the exuberance part, it's not me. So I don't listen to channels like that. I listen more like Warren Buffett examples of he makes a ton of money because he loves investing. He loves learning. He loves doing what he does. That's the kind of investor that I want to follow. All right. Next one. Do you have email address? So let's talk through messaging, and then what I'll do is, if you go to my channel, you'll see my email address, and then just in your email to me, and I'll put it on here. All right, so you guys could see my email address. Or I got to show it to you guys. So there's my email address. If you email me, Tutonomy, you got to remind me that your handle is Tutonomy, because you might, I don't know what your name is. Like Gabriel Valenzuela, I know what his name is, but I'm willing to bet that your name is not. Well, maybe it is, and I apologize if I made the wrong assumption. Just remind me what your handle is, and then I know who you are, and be happy to engage with you and see how I could help you. I'd love to get your advice on real estate, because I'm an investor, but I don't own 47 apartments. I own fewer. And I've been trying to, every time I look at a commercial deal, I talk myself out of it. So I think I could use some mentorship there. Is I look at a commercial property, do I need to look at it differently? Because it is an area that I'd like to grow my investments in. All right. So Bad Omen. So yeah, I'll put out my email, and I think that's where you can go. So USA 1986. Cool. All right, cool. You got my email address. All right, guys, it's been a great session. Thanks again for tuning in, for all your support to the channel. I really appreciate it. Everybody have a good night.